Welcome back to another episode of FinTech Fridays and Happy New Year, everybody. I'm excited about today's guest and topic. It's a very timely topic with the calendar changing over and, of course, our administration changing over. Matt Jones with the Mortgage Bankers Association is joining today. Matt, thanks for coming.
Absolutely, Brian. Thanks for having me. Happy New Year and great to see you again.
Yeah, so we're recording this just for full transparency for the audience. We're recording this on the 7th of January, and we'll publish this on Friday the 10th. Yesterday was kind of a milestone day in DC with, I guess, the confirmation of our administration change. And just would love to get your perspective, Matt, and of course, MBA's perspective on, what are you looking forward to? What are you guys kind of predicting, I guess, as we near the administration change as it relates to housing finance specifically?
Sure. Well, the great thing about the business we work in and housing more broadly is that it's bipartisan, right? So there's always an opportunity wherever, which party's in charge to make real progress. And there's a little bit different focus from a trade group perspective on the types of things you want to emphasize and dial in on. But I think fundamentally, there's real opportunity when it comes to affordability, right? And that's obviously the buzz for years, but certainly post-COVID with the lock-in effect now, massive inventory shortages. And I think a key opportunity, which we can get into, is going to be the upcoming tax debate, because the Trump era tax cuts from 2017 are scheduled, or at least some of them are scheduled to sunset at the end of this year. And so that's going to be a key opportunity for us and practically everyone else in DC to come to the table and talk about what our tax code should look like. And certainly every member of Congress you talk to, they're bringing up housing affordability. So expect that to feature pretty prominently in that broader discussion, right? But also, and the point we've made is there's been a lot of proposals during the Biden administration on demand side tax credits. That's really not the problem. The problem is on the supply side, right? You can actually build more, then you can actually bring some of this pain down. And so expect there to be, I think, a broader discussion around how can we influence more construction. And there's limited, carrots and sticks that the federal government has. Frankly, it's mostly a local issue. But things like looking at building codes, which you can also get into, there was a pretty controversial HUD and USDA policy that was rolled out during the Biden administration that we're hopeful can be rolled back under Trump, which we think would be positive. And then also just supply side tax credits and things that can, again, incent people either to build more and also to consider, if they've been looking to move, but they're kind of scared by the interest rate environment, maybe can get them off the couch and
Yeah.
to consider that now.
Yeah, let's poke a little bit at the legislation that you mentioned that was enacted in the Biden administration and may or may not get rolled back. But can you just explain a little bit about what that legislation was, how it impacted our industry, and then potentially what that might look like if it does roll back?
Sure. So distinguishing legislation from administrative policies, right? About May, I want to say, don't quote me on that, last year, HUD and USDA finalized a rule that basically says that a new construction of a single family home has to comply with the 2021 International Energy Conservation Code in order to be eligible for FHA insurance, right? So basically you can't get an FHA on this brand new house unless it complies with the 21 code, which sounds great. Like we like homes that are built according to code, right? The problem is 32 states are still on the 2009 code. And in those states, they don't have housing inspectors that even understand the new code. And according to our research in collaboration with the National Association of Home Builders, the delta on moving a home from the 2009 standard to the 21 standard is between $20,000 and $30,000 of upfront cost to that first-time home buyer. So in our view, that actually incentivizes first-time home buyers to buy older housing rather than the new housing that's being built. So we've been very critical of that policy. For a time, it appeared also that FHFA might be following suit and adopting the same kind of restriction for Fannie and Freddie lending. Fortunately, that didn't come to pass. And we're hopeful that the Trump administration is going to revisit this. Clearly, it's a battle between kind of environmentalist concerns and housing affordability. And ultimately, I think, in my view at least, if you ask most voters, is it worth paying that additional $20,000 or $30,000 so that maybe you save a couple nickels of like utility bills? That doesn't add up, and you're front running that cost for the next 30 years, whoever owns that house, right? So probably 4 or 5 different consecutive owners, you're paying that forward for them. Very anti-affordability, and so that's something that we've been fighting pretty vehemently during the Biden administration. I think we're optimistic that the Trump administration will be able to reverse it.
You add that $22,000 to the already, what is it, like 80 some $1,000s on average before you put a shovel in the dirt for a new build with all the code and fees and permits and all that.
Right, right. The regulatory costs and obviously the land value keeps going up. In Michigan, it's a little bit easier than a lot of places.
Yeah.
But yeah, and also not just the building costs, but in the mortgage origination process, it's something like $6,000 to $7,000 per loan of just if you separate out regulatory costs of compliance, if you were to kind of distribute the cost of your compliance shop that's required to be very robust under our current regulatory environment, if you were to distribute that over the number of units originated per firm, it's something like $6,000 or $7,000 that gets layered on. Ultimately, it's indirectly borne by the home buyer, right, or the person refinancing.
Yeah, that's such a great point, Matt, because if you think about the year over year change in volume, not so much 23 to 24 and 24 to 25. I think those are going to end up being, relatively flattish. Maybe let's be optimistic and hope that 25 is a little bit of an uptick, but coming off of, massive volume years, you can't underestimate the compliance requirements on a lender, in particular an IMB. And then when you factor in when most of these companies built this infrastructure for compliance, they built it and put it in place in a different market with
Right,
higher volumes and frankly higher margins,
right,
but you can't just yank it out. It's
right,
not, it to me, the compliance cost for IMBs is not necessarily a scalable cost, right? It's kind of a fixed required element to be in the business, and it is a substantial part of the cost per transaction today.
no question. And it's also a very high floor for a new entrant that might want to come in as a new IMB. You don't see a lot of them now because there's so many high floor between that and what it takes to get your agency tickets if you want to go that route, or Ginny tickets. It's hard to enter this business without a huge amount of capital because you've got that much, regulatory corpus that's been layered over time. And to your point, it's constantly changing. So it's hard to budget for, where, it's a cyclical business. Interest rates change, but also the regulatory enforcement changes. And it feels like there's just more and more that's getting stacked on every year, regardless of what the market.
So let's not necessarily shift gears, but maybe go another layer into kind of, what you all at MBA are predicting, projecting in terms of impact to our business with the new administration coming in, the new old administration.
Yeah, yeah. Trump 2.0.
Right.
So certainly, and again, important caveat that as we're filming this, it's about 2 weeks before Inauguration Day. There's still a lot of things that are being figured out, and hopefully what I say doesn't end up being wrong. But we anticipate there's going to be a very significant push in the new administration towards GSE reform, and specifically getting Fannie and Freddie out of conservatorship. There's been a lot of reporting on that. And it's something, of course, MBA has been historically very involved in. It's also something I was personally involved in when I worked on the Hill during the last major push to take a look at it in 2019, right? This has been a kind of intractable issue for almost 20 years, right? It was never intended in 2008 that Fannie and Freddie would be quasi government owned in perpetuity, and yet that's the way it's played out. Uh, since a few years ago, the GSEs have begun retaining earnings based on their quarterly earnings, which has been substantial. We're talking, 12, 13, $14 billion a year at Fannie, which adding up over a period of years, they've been able to now build up a substantial amount of capital, where based on, some estimates, they could get to the point where they comply with their own FHFA imposed capital rule within 5 or 6 years from now, just on retaining their earnings. So again, the conversation is returned about what is the appropriate time to exit conservatorship, but not only when, but how should they look post conservatorship. And so a particular point of emphasis for MBA is the importance of establishing an explicit backstop on the MBS, because otherwise you have the complete outstanding market globally of agency MBS. If it's not perceived to be explicitly guaranteed by the federal government, would be written down, right? And so ultimately the value of all the outstanding MBS would be impacted, and that's not a small thing to take into account. And also going forward, and there's a fair debate about the appropriate role for Fannie and Freddie and what the credit box should be. But again, if they're exiting and they're perceived to be private companies that could fail again, their credit risk is going to decrease, right? Deteriorate, and that impacts mortgage rates for everyone. So it's really an important it's a technically challenging topic that frankly requires a huge amount of education, not just with the incoming administration, but also on Capitol Hill. Because keep in mind the congressional staff that ultimately are playing a big role in advising their bosses, the elected representatives, on these issues. Virtually, 75-80% of them are new and haven't been around since the last previous legislative push. In fact, to that point, we're going to do tax reform again. 60% of the congressional staff weren't around for the Trump era tax cuts in 2017. So there's so much of an education process that MBA with our legislative team has already been engaged on. That's going to be a major policy issue that we expect us to be very involved and worth following for sure, because it'll impact virtually every aspect of the business.
In the obviously with housing is clearly one of the the biggest components of our economy, right? Yet I don't know that it's going to be the number one priority for the new administration. So just from as you think about the next 4 years, does MBA look at this as there's work to be done, there's education to be done, there's engagement to be had, but is this really like a second half of the term type of thing, do you think, or potentially earlier?
So we think most likely the initial push will be for the tax reform to be considered this year, right? So Trump has 4 years, but they can only count on the first 2 years where they have a majority in the House and the Senate. So this is really the key opportunity for them to put their first top priority through, which we expect will be revisiting the tax code. And when you're doing tax policy, you have the ability to pass it on a simple majority in the Senate through what's called a reconciliation process, where they don't need 60 votes in the Senate like they do for everything else. So we think just the scale of what that's going to take from a political capital standpoint, it's going to suck all the bandwidth out of the first year, right, to get that done. There's been some talk about potentially talking about the GSEs in the context of a budget reconciliation. We think that's a little bit more complicated than maybe it's being made out to, right? But ultimately, yeah, I think the GSE release is likely to be a second half of the administration consideration, notwithstanding the press attention it's gotten in the last couple of weeks, because it was always viewed that they would be more likely to exit conservatorship in a Trump win rather than a Harris win. So that's why we're hearing more about it. But yeah, I would be surprised, although I'll be cautious about it with everything. But I'd be surprised if there's immediate changes in the next couple of months.
No, I think that it's kind of where my head's at. It's just, when you start to stack priorities, those that are most important, are going to be what gets, pushed to the front. Again, not discounting the importance of housing finance, but there's a little bit of, if it's not broke, let's, kind of keep it going, right?
That was always legislatively, and I think if this happens at all, it's more likely to be an administrative path rather than Congress setting the terms. But in every previous historic effort legislatively, the process always broke down in the complexity, and most of the members have a particular interest, and then it becomes like a Rubik's cube to get a coalition together to get this done. And to your point, ultimately, at least today, the GSEs are performing, they're profitable, but we certainly can't take for granted that that's always going to be the case. And we want to make sure that they have the safety and soundness as entities to exist outside of government conservatorship so that they don't fail again, because they
Right.
already have failed.
Yeah.
So that's an important to include in the discussion as well.
All right. So what else are you guys? What else do you have your eye on here as we kind of make this transition?
So another key, I think, opportunity that we've been working on for the last year and will continue in the Trump administration, there's been a lot of talk about servicing liquidity, and particularly for government servicers. During the Biden administration, there was a big push by FSOC, the Financial Stability Oversight Council, which is basically a council of all the prudential banking regulators that are looking at potential risks to the global economy. And one thing that was, fell within their crosshairs during the Biden administration was IMBs, and particularly the ones that are servicing government loans, where through Ginnie Mae remittance requirements, you're obligated to advance the PITI, regardless of whether the borrower is paying it, forever in perpetuity until the ultimate, foreclosure, which can be years, particularly in judicial foreclosure states. And indeed, in the post-COVID environment, where we now have long-term forbearance as a regular policy tool, the expectation has shifted now to, you're not actually paying on your mortgage for years. That's become much more common, and I would expect fully that the next time we have an economic crisis, Congress will turn to that forbearance tool again, right? The precedent's been set. So fundamentally, the way we make assumptions about government servicing has changed, and so it creates a real liquidity risk for any servicer, not just banks, not just non-bank servicers, but bank servicers, credit unions. And so there's been a lot of conversation around how do you solve for that? What ultimately is really fundamentally a timing mismatch between when the servicer gets reimbursed from FHA insurance or a VA guarantee, and when they're out of pocket on these advances, which can be a delay of several years. Ultimately, it's money good, but you gotta step in for the period in the middle, right? And so what we've done is propose several different opportunities that the Trump administration can take on day one to solve this fairly quickly. And rather than blame IMBs for having less capital than banks, which has been a talking point, right? How about we look at the actual structural problem within Ginnie Mae, and specifically that's the timing mismatch. So one thing that we think is a real opportunity, and FHA actually just released a mortgagee letter last week on this, would be to allow a mini partial claim, a mini reimbursement of the T&I advances every 6 months, rather than waiting until the very end, creating a iterative reimbursement through, every period of time. That would significantly improve the liquidity strain on servicers. That's something that we think has legs, and we're going to be very supportive of it and hope that the Trump administration will continue, going down that path. Another one, and this is a white paper that we just released, is what we call EBO securitization, which is fairly technically complex, but fundamentally what we're suggesting is today, if you have a non-performing, say, FHA loan as a servicer and a Ginnie Mae issuer, you have the option of continuing to advance as long as you have to, or you can buy the loan out of the pool, hold it on your balance sheet, maybe it reperforms, and then you pull it back in the future. But it's very capital intensive, obviously, to buy the loan out at par, especially given that interest rates have changed. Maybe this was a loan that was originated at a 4% coupon, and now you'd have to take a 20-point haircut to buy it out today. So what we're proposing is a third potential execution option for issuers, where they can buy the loan out of the pool and re-securitize it into a new type of Ginnie Mae security, where it is an accrual rather than a monthly remittance. In other words, the investor in this security gets a discounted cash flow of all the promised principal and interest that's paid at the end, typically when the loan resolves through foreclosure, rather than having the issuer make the monthly payment. It's just an accrual at the end. So in some ways, it's very analogous to like a reverse mortgage. Now, we recognize that's not going to work in every case. Again, the interest rate disparity will matter there. But looking forward, if we assume a more level rate environment where maybe there's less of a difference between the loan in question and the market rate, this may make sense as a potential tool to, again, reduce that liquidity strain by, basically doing an end run around the advancing requirement. So we're trying to be creative in thinking about solving for that structural problem, recognizing that going to Congress is hard for anything. There's certainly things Congress could do to solve it immediately, but legislation is hard. In our view, there's many opportunities administratively within Ginnie Mae's own authority, within FHA's authority, that they could solve this if they wanted to pretty quickly, and it would make a huge impact, not just for IMBs, but if you think about it, if the assumptions about what it means to service an FHA loan improve
Yeah.
and it becomes cheaper, that ultimately passes through. It's accretive to the first-time home buyer in the form of cheaper loan pricing. So the value flows through to everyone involved. And so we think that's a big opportunity. Let's stop the rhetoric about IMBs having less capital than banks and fix it structurally so we can benefit the next generation of home buyers.
Yeah, I mean, the reality, Matt, is as the things that you've described, if any of those are implemented, it changes the narrative in any organization on the risks associated with servicing Ginnie Mae loans, meaning we could see banks get back into that space, which would be good for the market.
Yeah, absolutely. And that brings up a broader conversation about the bank's mass exit from Ginnie servicing. And that's not just about advancing, it's also the capital treatment of MSRs under Basel, which is also something we've been very critical of historically. You know that the 250% risk weighting that is assessed to MSRs was originally put in place because MSRs were hard to define. And so they decided to put them in the same bucket that we put subprime auto debt. It's a hard to define asset. And then there's inertia, and that's where it got stuck. So it's been sticky in that 250% risk weight for years, but it makes it completely uneconomic for a bank to be in that business. And so think about the potential competition that you're giving up, and competition benefits consumers just by saying banks can't really meaningfully participate beyond the 10% cap of their tier one assets. But it's been kind of intractable, and we're fortunate that with the new administration, we expect the proposed Basel endgame is going to be reversed, which would have made it even worse. The other thing that would have proposed, by the way, is doubling the capital charge associated with unused portion of warehouse lines. So it would have pushed warehouse lenders out of the business too. So again, these things matter. They have ultimately an effect on the cost of lending. To the extent we can get banks to come back in and compete in the government servicing landscape, that should benefit consumers immensely. The other thing, candidly, that has pushed banks out is the perceived litigation risk within FHA on the False Claims Act. And that's something that during the Trump administration 1.0, they made a meaningful effort to improve through a memorandum of understanding with DOJ. That's still in place today. Opportunities, absolutely, but a lot of it is improving that capital treatment of MSRs to actually get banks to come back. IMBs are monoline. Banks have multiple different financial products, and a lot of them have made the assessment that mortgage is less worth their capital, their marginal dollar, than other business lines, and that's not good for anyone.
Yeah, and besides the impact, the benefit to consumers, which makes sense, there is a benefit to a segment of IMBs, in particular, those IMBs that don't necessarily hold servicing and they're a net seller. This could bring some of the bigger banks back into the MSR acquisition channel for Ginnie Mae servicing, which again, more competition, more liquidity, hopefully factors into potentially better margins for the originators and then again, ultimately rolling back down to a benefit to the consumers.
Absolutely. I mean, any additional demand for buying MSRs improves the premium you can sell it for, and that improves the loan price to the consumer. The other thing that we've talked about, and this would be a legislative ask, but if you could just raise the Ginnie Mae G fee slightly to offset the advancing requirement, maybe cut it off at 4 months, the way that it works within Fannie and Freddie, that would be sufficiently accretive in our analysis to actually benefit the borrower overall, because the cost benefit of servicing would improve so much it would more than offset the increase in the Ginnie G fee. We think politically that's tough though, right? Asking for a G fee increase, even though it ultimately would net out to the borrower's benefit, that's challenging. And it's also going to Congress. So that's something that we think would also make sense, but realistically, I don't think that's likely to happen. But there's so many opportunities to get at the same.
So we talked about some big issues, right? And I think what I want to make sure our audience recognizes is the great work that the Mortgage Bankers Association does on behalf of our industry, all of the participants in the industry, and ultimately the consumers that we all serve. But I don't know that everyone's aware of how much information is available to members of MBA. You mentioned a couple white papers as an example. Can you just remind folks, where that information is, how they can get their hands on it? Because I think all of us need to be very well versed in all of these topics. It just makes us a better value provider to the consumers that we serve.
Absolutely. And thank you for the opportunity for the plug. So I don't think people realize we have 160 staff at MBA. We're a very large organization relatively as trade groups go. And that gives us the ability to swim in a lot of different channels and offer a lot of different benefits to our members. Certainly from my seat, we do policy advocacy. We've got a 15-person team that covers everything kind of Article 2 with the administration, from HUD to the GSEs to CFPB, which we haven't talked about, and know that we're engaging with those policymakers on a regular basis for the benefit of our members. In addition to that, we've got our legislative team that's on Capitol Hill. We have 5 lobbyists that are all seasoned veterans at doing what they do. We also haven't talked about trigger leads, but that's another potential conversation. And then in addition to our advocacy, of course, we have our research and economics team that puts out a lot of data that the industry has come to trust and reference over time. And then we also have our education team that provides a lot of different products for our members to help educate their teams and provide continuing education and strengthen, existing expertise. And that's been growing substantially as well. But as it relates to policy engagement, we have many different ways that anyone, no matter who you are, an executive, a loan officer, an underwriter, can get involved with what MBA does. We have on the residential side a number of policy committees that have regular kind of Zoom calls, typically, where we're picking our members' brains on what's going on, making sure we keep our ear to the ground, that we're advocating on behalf of the most important issues of the day, that we're not missing something. And then when MBA is often asked to comment on a certain proposed rule or legislation, we're making sure that we're using our members as a sounding board. Oftentimes, getting involved in those types of committees becomes also an opportunity to get more involved in MBA leadership long term. That's really kind of the pool that we draw from as we're looking not just for leadership, but opportunities to speak at MBA events, et cetera. But that's really a great way to get involved. We also provide regular kind of updates to those committees online to make sure everyone's getting the latest information. And we break it down. So in loan production, for example, we have a government lending subcommittee, which my colleague Darnell Peterson oversees, which is a great forum for government underwriters to talk about FHA handbook changes, VA guide changes. And not to get too much on a tangent here, but one thing we've also been looking at recently is the growing use of buy now, pay later products like Firm and Klarna, which currently it's really a novel issue. There's not an obvious practice that the agencies have adopted on how to underwrite them, and they don't show up on credit reports because it's not reported to the bureaus. So lenders are picking them up typically on their bank statement. We're working, and what I think is a novel effort in collaboration with the agencies to figure out what the appropriate way to underwrite it is and what the rules should be. So this is a key opportunity for our members to engage and think about how you balance production versus risk and those types of things in setting that. But those are the types of opportunities we have, and I think a lot of our members don't realize that they're there. All they have to do is reach out, and you can register for any of these committees on our website. You can also easily reach out to myself or anyone on our team, and we can get you plugged in that way.
Yeah, I think one of the things that I would recommend that member companies do a better job at is making sure their broader staff is aware of the resources available through the company's membership, right? It's not, MBA is not an individual member base, it's a company membership. And so your company being a member of MBA, everybody has access to this information. And I mean, there's not a week that goes by that I'm not on the MBA site, looking up something or getting information. And so I want to make sure we cover a couple topics, and you already kind of teased these out. And I know we're past our target time, but this is great, timely information. Matt, real quick, give us an update on triggers. Obviously, it didn't get done in 2024. What are we looking at for 2025 on the trigger lead legislation?
Yeah, so look, legislating is hard, and I think, we did not get across the finish line in the current or the previous Congress that ended a couple days ago. We were able to, in the Senate, get almost the majority of senators to co-sponsor the bill, right? And so that the common joke that our Vice Chair Owen Lee gives is, what do Tommy Tuberville and Elizabeth Warren have in common, besides the same vowel in their last name, is that they're sponsors of our trigger lead bill, right? This remains a massive pain point for our members. in that they are constantly getting blamed for these bombardment of calls anytime you pull credit. And the lenders get blamed for it, right? When it's not the lenders that sold the data, but they're perceived to have been the ones that sold the data. We ultimately had certain members in the House that were not willing to sign off on it. But fortunately, hope springs eternal. We've got new members and we've got new staff in the House that we think we can work with in the 119th Congress. And there may be an opportunity to move forward with the bill that we put all that work into. One thing that I would flag again is kind of a shameless plug, but in April every year we have our National Advocacy Conference, which is a great opportunity to come in to DC, fly in. We kind of give you a quick primer on all the policy issues, and then we send you up to meet with your member of Congress and your senators or their staff. And last year we had almost 300 meetings on the Hill in one day, bombarding everyone on trigger leads. And it makes a big difference. And we found that talking about the problem creates a visceral reaction from a lot of the members of Congress, because of course, who wants to get bombarded with all these calls? And frankly, members of Congress and their staff, while they hear from MBA all the time, it really moves the needle more if they hear from their own constituents, the ones that vote for them and the ones that create jobs in their districts, right? So it really does make a huge difference. Even if you're not seasoned at articulating it, just showing up makes a huge difference. And so would definitely point to that as a big opportunity. We storm the Hill, and that's coming up in just a couple months. But again, we're not going to give up on the trigger leads front. It's a key priority for our leadership, and we're going to bring the banner up to the Hill yet again and try again.
I'm optimistic that we're going to see a victory in this new Congress. So you keep pushing on that one. Last topic, CFPB. You kind of mentioned the CFPB. I don't think we're going to delete the CFPB, right?
Well, again, there's always been a lot of frustration around the CFPB within our industry, as we touched on earlier, because a lot of it has changed over time. A lot of it is not written down, and we find out what the rule is because someone's door has been kicked in with an enforcement action, and we learn that way, or through a blog post that doesn't have to go through a formal, APA rulemaking process. All those things still matter, and but on the flip side, it would be a mistake to assume that in a new administration that the regulatory tone is going to be completely shut off, right? And that there's not going to be enforcement actions, right? That would be a mistake. Important to remind folks that during the Trump administration, there were actually just as many enforcement actions as in the administration before. And so keep in mind, yes, we're going to be pushing to ease the tone on a lot of this stuff to get more clarity around a lot of new issues too. We haven't talked about AI. That's going to be a key piece there. And if I could just briefly, it's probably worth mentioning since this is the FinTech Fridays podcast.
Yeah.
One thing to keep an eye out for is obviously state legislatures around the country are trying to get their arms around how to regulate AI. And we've actually found the mortgage business is starting to get caught up into that, and not in a very favorable way. The state of Colorado just passed a law that would subject the GSE's AUS engines to the oversight of the state government in Colorado, right? And so yes, the DU and LPA are kind of black box underwriting engines that we don't fully understand, but certainly it's not going to be a helpful force that we have, state, governors poking around to try to solve it. And also, while, we know DU's not just used for agency underwriting, it's kind of used as the proxy for everything, even in non-QM. We need to be really cautious about these efforts to under ostensibly valuable regulation of AI, making sure that we don't create unforced errors in trying to regulate these types of things. There's also an effort similarly in California that's ongoing that we're trying to stamp out, and a couple of other states that are thinking about it. So that's going to be a key thing in 25, is making sure that MBA doesn't get caught up in the draft of AI regulation. And I think the CFPB could play potentially a role in that process as well.
Man, we covered a lot of ground, and we probably just scratched the surface on a bunch of these topics. So I'm going to make a request that you come back in a couple months once the first layer of dust settles, I guess, and we might maybe do a reassessment on what's gone in play, in call it Q1, and then kind of revisit some of these topics. But this has been super informative, very helpful. Always love catching up with you, Matt. Again, appreciate and value all of the great work that the team at MBA does for our industry and ultimately for all the consumers that we all serve.
Brian, I have so much respect for you and great to catch up with an old Michigander friend, and we'll see you soon. Thanks for having me on.
And we got to give a go Lions before we go. So go
Go Lions.
Lions.
First round bye.
Right on. Thanks, Matt. Thanks everybody for joining in. Tune back in a couple weeks for the next episode of FinTech Fridays.